The balance sheet has its limitations, but it also has very useful properties. And now that we've talked about how assets and liabilities are grouped as current versus non-current on the balance sheet, let's discuss why that grouping actually matters. This split is helpful to financial statement users because it lets them assess a range of characteristics about a company. So, a few terms to lock in. Number one, we've previously considered liquidity at the asset level. Again, for individual current assets, liquidity refers to how easily you can turn it into cash without losing value. And that's why current assets are presented on the balance sheet in order of descending liquidity, with the most liquid at the top and the least liquid towards the bottom. Now let's scale that up to the company level. The liquidity of an entire company refers to its ability to meet short-term obligations. As the bills and short-term loans come due, how well positioned is the company to pay those off? We can contrast that idea with solvency, which refers to a company's ability to meet long-term obligations. It's the same general idea, just over a longer time horizon. Financial statement users, both equity investors and creditors, care deeply about both. They want to know if the company can stay alive in the short run and stay healthy in the long run. So, how do we keep tabs on it? Typically, through financial statement ratios. Let's start with liquidity ratios. And first, another quick definition. Working capital is defined as the difference between current assets and current liabilities. It's the cushion a company has in its short-term resources. Positive working capital means more current assets than current liabilities, which gives the company room to operate. Negative working capital can be a warning sign, although context always matters, and that's actually a great spot for a heads up. Whenever you're doing financial statement analysis, you need to resist the urge to label any given ratio as good or bad in the abstract. It is always important to consider the industry, where the company sits in its life cycle, and what's normal for similar businesses. Liquidity ratios capture the strength of a company's working capital. And the first one we'll consider is the current ratio. Total current assets divided by current liabilities. Now, a kid in elementary school, they can do the math here. The real skill is interpreting it. My approach is to start with the denominator. The current ratio tells you that for every dollar of current liabilities, the company has X dollars of current assets to satisfy them. Now let's look at the quick ratio. Pause for a second and compare the two formulas. What is similar and what is different? The denominator is identical, total current liabilities. And both ratios are asking how well a company can pay off liabilities due within a year. But the numerator has changed. The quick ratio only includes three categories: cash and cash equivalents, short-term investments, and net accounts receivable. Inventory and prepaid expenses are deliberately excluded. And why exclude those two? Well, one, inventory has to be sold first, and prepaid expenses get consumed rather than converted to cash. So the quick ratio is asking a tougher question. Using just the assets that are basically cash or close to it, can you cover what's due? It's a higher hurdle to clear. Now let's switch over to solvency. There are a variety of solvency ratios out there, but the one we're going to focus on today is just the debt ratio. Remember, solvency is about a company's ability to meet long-term obligations. The debt ratio also gives us something useful, a window into the company's capital structure. Capital structure, that just refers to the extent to which a company's assets are financed with debt versus equity. The more debt a company has as a percentage of total assets, the greater its leverage. The debt ratio formula is total liabilities divided by total assets. And the interpretation is pretty straightforward. It tells us the percentage of a company's total assets that were financed with liabilities or debt, instead of through equity from owners. All right, let's put all three of these to work with an example. On the screen is a condensed version of the balance sheet for DoorDash. Pause the video, will you, right now, and calculate each of the three ratios we just discussed. More importantly, try to articulate an interpretation for each one. Imagine you're trying to explain what each ratio is telling us about DoorDash, perhaps even to your grandma, plain language. So pause and give it a try. All right, hopefully you gave each one a real shot. Let's start with the current ratio. We're going to take total current assets divided by current liabilities. That's $7,700 over $6,000. Rounded to two decimal places, we get approximately 1.28. So, for every dollar of liabilities due in the next year, DoorDash has $1.28 of current assets available to pay them. That's your interpretation in plain English. Moving on to the quick ratio. Look at the four current asset categories on the balance sheet. Which ones are we going to include versus exclude? We're going to leave out that bottom one, prepaid expenses and other current assets. That leaves cash and cash equivalents, short-term investments, and net accounts receivable. So as a quick aside, do you notice which current asset category we've talked about that's missing from this list entirely? Inventory. And if you think about what DoorDash actually does, it makes total sense. They run a delivery platform. They don't carry material amounts of inventory, so the absence here isn't a missing line item, it's a feature of the business model. All right, back to the ratio. The denominator has not changed, but we're going to be dividing $6,600 by $6,000, which gives us a quick ratio of exactly 1.1. So DoorDash has $1.10 of quick assets to satisfy every dollar of current liabilities. Okay, last one, debt ratio. Total liabilities divided by total assets. That's going to be $8,600 over $18,800, which works out roughly to 46%. So about 46% of DoorDash's assets were financed with debt. That's nearly a 50-50 split between debt and equity financing. All right, good job on calculating and interpreting those. Now, I want you to walk away from this video knowing that these ratios actually matter in the real world. Financial statement users monitor them constantly, and they often drive real decisions about whether to invest, whether to lend, and on what terms. When companies take out significant loans, those loans often come attached to debt covenants, where the borrower agrees that certain ratios will not fall below or above any specified threshold. Break the covenant, and the loan can be called or renegotiated on much worse terms. Suddenly, that abstract number on a financial statement has real teeth. So, the next step in your accounting education is learning not just what goes into these ratios, but how individual transactions impact them.